What's going on, everybody? Ryan Thompson, the Assumable Guy. This is the Assumable Guy Show. Today we're talking about credit scores and assumable mortgages. Specifically, can you assume a mortgage if your credit isn't great? And I'm going to tell you right now, the answer might surprise you. Here we go. So let's start with the big question. Can you assume a mortgage with bad credit? The short answer is yes. For most assumable loans, the credit requirements are way more flexible than getting a brand new mortgage. And I want to be really clear about that because I think a lot of people count themselves out before they even pick up the phone. Here's the thing. When you're assuming a loan, you're not applying for a new mortgage. You're stepping into the seller's existing loan. The lender already made that loan. They already approved it. They already funded it. So the qualification bar for the person coming in, meaning you, is different than if you were starting from scratch. Let's break this down by loan type because it matters. VA loans. If you're assuming a VA loan, there is no minimum credit score requirement from the VA. Zero. None. Now, the loan servicer might have their own internal guidelines, and some of them want to see a 580 or a 620. But the VA itself does not set a floor. So if your credit is in the mid 500s and someone told you that you can't buy a house, right? That's not necessarily true with a VA assumption. FHA loans. FHA assumptions require a minimum credit score of 500. 500. Think about that for a second. A conventional loan right now typically wants a 620 minimum, and most lenders want to see a 660 or higher to give you a decent rate. With an FHA assumption, you're in the game at 500. And here's what makes that even better. You're not just qualifying at a lower threshold. You're also getting a rate that might be in the 2s or 3s. A rate you could never get today, no matter how perfect your credit is. Now, I know what some of you are thinking. Okay, Ryan, but if my credit is that low, is it even worth it? Am I just going to get denied anyway? Let me tell you something. The reason behind the low score matters way more than the number itself. If you had a medical bankruptcy 3 years ago, but you've been paying everything on time since, that's a very different story than someone who's currently missing payments on 4 credit cards. The servicers look at the why, not just the number. I promise you, I've worked with buyers who had credit scores in the 500s and got approved for assumptions. It happens. The key is having a clear explanation and showing that your financial situation is stable now. So let me walk you through the math because this is where it gets real. Let's say there's a home listed at $475,000. The seller has an FHA loan with a balance of $420,000 at a 2.75% rate. The equity gap is $55,000. Your monthly payment on that assumed loan, about $1,715 a month. Now compare that to getting a brand new conventional loan on the same house. At 6.25% on $475,000, you're looking at about $2,925 a month. That's a difference of $1,210 every single month on the same house. $1,210 a month. That's over $14,500 a year. That's a family vacation every year. That's maxing out a Roth IRA. That's the difference between feeling tight every month and actually breathing. And here's the kicker. You got that deal with a credit score that a conventional lender would have laughed at. So who's laughing now, right? Now here's something a lot of people don't know. When you assume a mortgage, the credit pull is typically a soft pull during the pre-qualification phase. A soft pull does not impact your credit score. So if you're worried about your score dropping even further just by applying, don't be. You can explore this, get pre-qualified, and see what you can afford without any hit to your credit. Once you move forward with the actual assumption, yes, there will be a hard pull, but by then you already know you're in the game. Little hack for you, if your credit is borderline, like sitting at a 540 or 550, use the time during the assumption process to boost it. The assumption takes 45 to 90 days to close, right? That's 1 to 3 months where you can pay down a credit card balance, dispute an error on your report, or become an authorized user on someone else's card. I've seen people bump their score 30 to 50 points during the closing process. By the time the servicer does their final check, you're in better shape than when you started. Now, here's a what-if scenario I want you to think about. Let's say you're a veteran, you've got a 560 credit score. A conventional lender tells you the best they can do is 7.2% on a $350,000 home That's about $2,380 a month. But I find you a VA assumption at 2.5% on a $400,000 home. Bigger home, better neighborhood, your payment on the assumed loan, about $1,580 a month, $800 less per month on a home that costs $50,000 more. That's the power of assumptions. Your credit score becomes way less important when the rate is already locked in at 2.5%. Now, sellers, here's what this means for you. If you're sitting on a home with a killer FHA or VA rate from 2020 or 2021, your buyer pool is actually bigger than you think. Buyers who can't qualify for a conventional loan can qualify for your assumption. That means more offers, more competition, and potentially a higher sale price because buyers know they can't get this rate anywhere else. So when your listing agent says, I don't know about this assumption stuff, you tell them to call me because marketing your assumable rate opens doors that a traditional listing just can't. Let me recap the credit minimums real quick so you have them in your head. VA assumptions, no minimum from the VA. Servicer may want 580 to 620. FHA assumptions, 500 minimum. USDA assumptions, similar to FHA, around 500 to 580 depending on the servicer. Compare that to conventional loans wanting 620 or higher. The difference is massive. And one more thing I want to make super clear. Having a lower credit score does not mean you'll pay a higher rate on the assumed loan. The rate is the rate. It's already set. It was set when the seller originally got the loan. Whether your credit score is a 520 or a 780, you're getting the same 2.75% rate, same payment, same terms. That's what makes this so powerful for people rebuilding their credit. Let's go find you a deal you didn't think was possible. I'm Ryan Thompson. This is the Assumable Guy Show. Next episode, we're getting into refinancing an assumed loan. Can you do it? When does it make sense? And why some people are sitting on assumed loans today that they'll never want to refinance. See you on the next one.